If you're anything like me, you've probably been checking the stock market the last couple of days and looked at your portfolio like, ugh. I know, it's pretty painful. But before you do anything drastic, I think there's three things you need to know about why your portfolio is going down. I'm Debt-Free Joel, and on my channel we talk about everything finance, from saving, investing, and most importantly, charity. If this interests you, feel free to click like and subscribe. Let's get to it. One of the first reasons why you're losing money in the stock market right now has nothing to do with the stocks you actually chose. It's because the Federal Reserve is actually raising interest rates. So you're probably asking yourself, what the hell does the Federal Reserve have anything to do with my stock portfolio? Well, there's two different things for you to consider. The first is that when the Federal Reserve raises interest rates, what happens is that institutional investors will naturally pull their money out the market and put it into bonds. Now, why are they going to do that? Because the Federal Reserve is offering a higher interest rate for you to invest in. So to balance the risky asset portfolio for institutional investors, they take the money out and they put the money in bonds. Well, when they take the money out the stock market, what do you think happens? It drops. The second reason why stocks drop when the Federal Reserve raises interest rates is because everything that has a variable interest rate in terms of debt becomes more expensive. So think about trying to find a house right now, right? Finding an interest rate of 3%, for example, is almost impossible, right? Everything at this point is about 5%. Trying to use your credit card, most credit cards have a variable interest rate. So as the Federal Reserve raises interest rates, credit card raises their interest rates. Now, why is that important? The less amount of money you have to put in the stock market because you're too busy paying for your debt, the less likely you're going to put in the stock market, which is ultimately going to lead to the stock market dropping. Think about it also from a corporate perspective. For a lot of corporations, especially in the S&P 500, they rarely use cash to do project, plant, and equipment type things for the company. They usually borrow money from the bank and then they finance it and they take whatever, whether they're going to buy a building or they're going to restructure something, that takes a lot of money, for example. They do that through debt. Well, if the Federal Reserve raises interest rates and the banks peg their interest rate to whatever the Federal Reserve does, it gets more expensive to finance, which means they have less money to put into their company, which means prices drop. So that's the first reason. The reason why the stock market is going down is because the Federal Reserve is raising interest rates to decrease inflation. And whether you like it or not, they're going to keep doing this until they can put a stranglehold on inflation, which is going to lead to more downward pressure in the market. The second reason why you're losing money in the stock market is specifically because of the stocks you've chose. What I mean by that is diversification. You see, for many of us, we're still kind of brainwashed about what happened in 2020. See, we basically closed our eyes and threw our dart at the stock market, and anything we bought went up. But the problem was a lot of us went with the herd. What I mean by that is we bought the same type of investment. We bought the same Teslas, we bought the same Googles, we bought the same Amazons, we bought the same ARK ETF, we bought the same Bitcoin, we bought the same Tesla, we bought anything that everybody was buying at exactly the same time. So I want you to think about something. If everybody bought the same thing at the same time, what do you think is going to happen when people start selling? Exactly. Everybody's going to be selling the same things at the same time. And what happens is a lot of people put their money into tech stocks. A lot of people put their money into cryptocurrency. So everybody made money at the same time. But unfortunately now, everybody's losing money at the same time. And if the majority of your portfolio is in tech stocks, you're really losing money. So one of the reasons I want you guys to think about is diversification is extremely important in your portfolio. Now, does diversification mean that you're not going to lose money? No. That means that you're going to lose less money. So what do I mean by that? If your portfolio has tech stocks, but it also has commercial staples such as Pepsi or those type of things, and it also has industrials like GM and all these other types of investments, what happens is that as you have downward pressure on the market, you're not getting hit only in tech. You're getting hit across the market, and maybe some other sectors aren't doing so bad. Maybe some of them actually going up for the day. So what you want to do is look at your portfolio and say, am I only invested in tech stocks? Am I only invested in crypto? Am I only invested in the most risky companies I can find? That probably means you're feeling more pain than normal when the downward market is actually happening, specifically because you have no diversification. So that's the second reason why you're losing money. You're not diversified. Take a good look at your portfolio and ask yourself, am I diversified? Do I have a broad enough spectrum of investments where if one sector goes down, I don't feel as much pain? I know it sucks. Take a look. And the third reason why you're losing money? That's right. your time horizon. For most of us, when we think about investing, we want to make money really fast, right? We want to be rich tomorrow. We don't want to sit there and wait for 30 years. We want to be rich next week. Well, the problem is that when your time horizon is really, really small, you don't allow the effect of compounding. You don't allow your stock to move. Here's the thing. Most people, and I know a lot of people are not going to like when I say this, but most people don't know what the hell they're doing when they invest. All they know is that they're investing in something based on a feeling, on an emotion, and somehow they get depressed because that emotion backfires and they lose money. Well, even if you did proper research on the stock, at the end of the day, you have to let it run. What I mean by that is you need a proper time horizon. So for example, if I buy a stock, I'm buying a stock for the next 5 to 10 years. I know. It may make some of you really uncomfortable to hear that, right? You can't hold on to a stock for more than 5 minutes, let alone a week. But I can look at it from the perspective of holding on for about 5 years, which means, do I really care what happens over the last 2 weeks? No. The reason why some of you are losing money is because your time horizon is 24 hours. Your time horizon is 2 days. Your time horizon is a week. Your time horizon is a month. You get the point? The reason why is because you're not allowing your stock to actually flow. You're not allowing your stock to move. You're not allowing yourself to maybe be wrong in the short term, but to be right in the long term. Yeah, let that sink in. You're not allowing yourself to be right in the long term because you're too busy worrying about the short term. So think about your time horizon. A lot of us don't like to lose money. It's what's called loss aversion. Loss aversion means that you actually feel more pain from losing money than you feel happiness from gaining money. I don't know about you, but that's me. I don't like to lose money. So you got to let your stocks run. If you are really confident in your stocks and you realize that it's because of the Federal Reserve, it's because of some external factors that have nothing to do with the stocks you bought, then let your stocks run. Buy it on the days that are down. You don't have to watch your stocks every single day. I promise you, right now I have no idea what the stock market did today. It is what it is. Why? Because my time horizon is 5 years. I can care less what's happening today. So that's the third reason why you're losing money. You're losing money because your time horizon is way too small. Broaden your time horizon. I'll say it one more time. You have to sometimes realize that your short-term analysis on your stock is wrong. So if the short-term is wrong, make sure your long-term is right. Let the stock play out because you bought it for a specific reason. And there you have it. Those are the reasons why you're probably losing money in the stock market right now. I know, it's painful, but don't allow your emotions to get the best of you when it comes to investing. That's my little nugget for throughout this whole thing is don't allow your emotions, don't allow the fact that you hate losing money, mess up your investments. Be a long-term investor, stay calm, you don't got to check it every day, and trust your investments. If you really did make a good investment and you think that you made the right one, you have to let it ride. If you're wrong, admit it quickly and move on. But don't allow your emotions to get the best of you in this market. It's tough for everybody, but keep it moving. I'm Debt-Free Joel. I hope you found these tips helpful. Feel free to leave comments below if you think there's other ways for you to combat this market. Feel free to follow me on Instagram at Debt-Free-Joel. I put everything on that page about finance, saving, and charity. And I'll see you guys next time.